Hello Accounting Superstars! Welcome to the Accounting Superstar channel. This is Professor Don Bush and I've been teaching accounting for about 30 years and been a CPA for about that long also. And I've got lots of good ways to explain accounting, so let's get started. Today we're going to learn about accounting for financing leases from the lessee's point of view. And we've been studying in the last few videos about operating leases. Now the rules for operating leases have changed greatly. The accounting profession wants all assets and liabilities listed on that balance sheet, so they changed operating lease rules quite a bit. But financing lease rules are pretty much the same as before, so if you've got an older textbook, that older textbook will probably be just fine studying financing leases. So we'll explain what's going on here. So we're working with when we get to a construction, the construction company you don't want to have work on your home. So here we are, accounting for financing leases, lessee, example number 1. So here we go. So first thing is we have to understand the facts. And what I do when I work out complex problems like this is I like to just take the time and list out what's going on, list out all the facts, and that helps me understand what's happening and all the information that's available. And also I get to put any numbers in a column right here because I like to use Excel when I solve these problems, and I hope you do too, because Excel will make your life so much easier. If you haven't been using Excel, now's a good time to start, folks, because it's a basic tool in the field of finance and accounting. So let's get started understanding the facts. Step number 1. 1.1, when we get to a construction, is leasing an electric generator from Power to the People. 1.2, the lease agreement begins January 1st, 2001, and 1.3, generator is not of a specialized nature. What does that mean? Well, it means that this is just a regular generator or was not specially built for when we get to a construction. Any construction company or any person can use this generator just fine. 1.4, the lease is non-cancelable. So when we get to construction, can't just up and quit this lease and turn the generator back in. Lease term, 3 years. The generator has a fair value at the beginning of the lease of $3,000. 1.7, the generator's economic life in years is 4 years. So they're going to lease it for 3 years and the whole entire economic life is 4 years. So it looks like when we get to construction is going to use this generator for most of its economic life. 1.8, estimated salvage value at the end of the lease. This is unguaranteed at the end of the lease. $500. Now I have unguaranteed in bright red because this is very important. It helps us determine the amount to be capitalized. So whether the salvage value is guaranteed or unguaranteed makes a big difference in the capitalization amount. No lease renewal options. When we get to construction, we'll not own the generator. So at the end of 4 years, that generator is going to be turned back in to Power to the People, and there won't be a renewal. 1.10, the incremental borrowing rate, collateralized loan for when we get to it, construction is 5%. So we'll capitalize this at 5%. 1.11, the lease payments are made annually at the beginning, January 1st, 2001. I've got in bright red, beginning of the year, and this is typical of leases. 1.12, when we get to construction, depreciates equipment on a straight line basis. And finally, 1.13, when we get to it, pays for executory costs, and in this case it's maintenance. So in other words, when we get to a construction makes their lease payment, part of that lease payment is going to be for maintenance. It could be that Power to the People wants to do maintenance every year on this generator, make sure this generator lasts its full 4 years. So things like maintenance, property taxes, insurance are executory costs, and the amount is $100 per year. So let's go down here and determine the amount of the payment. Now a lot of times in your textbook they will just tell you what the payment is going to be. You don't have to figure it out, but it's good practice to know how to do this, so in case you have to do it. So 2.1, find the present value of the residual value. Doesn't matter if it's guaranteed or unguaranteed, but just the residual value. Residual value, $500. We got that from up in the information. And since I'm doing this on Excel, I can just pull this number down. Interest rate, 5%, also found in the information. Lease term, 3 years. So the present value, the residual value, what we're going to do is use Excel, folks. You don't have to use Excel, but Excel is so darn easy. So we're going to go to formulas, financial, NPV, and we will get the answer. So here's what's going on. Go up here to formulas. Go up to financial and then down to NPV. There it is, NPV. And if the print's too small to read for you, I'll read what it is saying. So the rate, it's asking for the interest rate. The interest rate is 5%. Since I have all my numbers organized right here, all I have to do is click. I don't have to type it in. Now we're finding the present value of a lump sum in 3 years. So the first value is going to be 0. And the second value is 0. But in the third year, the value is $500, and all I have to do is click on it since I have it right there. So I am good to go. All I would have to do is click OK, and I would have the present value of a lump sum in 3 years. But since I already have it calculated out, I'm going to just cancel out of this. So the answer is 431.92. Very important number. So coming down to 2.2, determine the amount to be recovered through lease payments. Well, the fair value of the generator is $3,000. That's found in the information up above. And less the present value of the residual value, well, we just figured that out just a minute ago. So I got it from right up there, so I just pulled it right down here. And the amount to be recovered through the lease payments is $2,568.08. So here we go. Down a little bit further, determine the amount of the annual payment. Well, the amount to be recovered through the lease payments is $2,568.08. Interest rate 5%, comes from up in the information. The number of annual payments at the beginning of the year, I have it in bright red to remind us, three of those payments. Amount of annual payments, well, we're going to use Excel again because Excel is so easy to use. And we're going to go to formulas, financial, PMT, payment. And the type is going to be 1. I'll explain what that is in just a second. So going up here to formulas and then to financial and down to PMT for payment. So the print might be a little small on your screen, so I'll read it to you. So the rate is 5%. All I got to do is click on 5%. The number of periods is 3. I'll just click on 3. There we go. The present value is $2,568.08. So I just click on that, and there you go. We have it. And we have to come down here to type. And what we need to do is type in the number 1. What's going on here? The number 1 means that the payments are at the beginning of the year. If the payments were at the end of the year, just leave it blank. But the payments are at the beginning of the year, so we're going to type in the number 1. So I would hit OK, but I already have it figured out, so I'm going to just cancel it out. There we go. The payment is $898.12. Now, we have some executory costs that when we get to it, construction has to pay to Power to the People. And so the total payment is $998.12. Coming down here to the next step, folks. It sounds like we have a lot of steps, but you know, if you follow these steps and do each of them, the problems are really quite easy. And if you skip these steps, they become quite difficult. Step number 3, the amount to be capitalized by the lessee, the present value of minimum lease payments. Now, there are 4 different types of minimum lease payments here, and what we do is we just go through them, and most of the time it's really easy to figure out what they are. So the first one here, rental payments excluding executory costs. Right there, $898.12. Where do we get that? We figured it out just a moment ago. Right here. The amount of the annual payment, and that does not include the executory costs. So the bargain purchase option, there is no bargain purchase option. When we get to a construction, cannot buy this generator for $1 or $10 or a really good deal. There's no such thing in the contract, so it's zero. Guaranteed residual value, there is no guaranteed residual value. There is an unguaranteed, but we don't include unguaranteed, only guaranteed. Penalty for failure to renew the lease. Well, the lease is not going to be renewed at the end of 3 years, and so there's no penalty. So the present value of the rental payments, here the amount to be recovered, is $2,568.08. That's the present value of these 3 payments here. And where can we find that number? We can find it right up here because we already figured it out. Here it is. Folks, right there. It's listed twice. So coming down. So what we want to do is double check here more or less. Let's just determine if this is an operating lease or a financing lease. So here's how it goes. I've already got the questions answered so you can see what's going on here. If any one of these answers here is a yes, that means it's a financing lease, and we have a yes right here. Otherwise, they're all no. So let's go through them just for practice here. Transfer of ownership. Does when we get to a construction own this generator at the end of the lease? The answer is no. When we get to a construction, it's going to return the generator. Is there a bargain purchase option? No, there isn't. Is the lease period 75% of the economic life? I've got yes. Now, how does that work? Well, the lease is going to be for 3 years, and the economic life of this generator is 4 years, so 3 divided by 4 is 75%. So here's the question, is the lease period 75% or greater of the economic life? And the answer is yes. And so it's a financing lease, we know that, but let's finish out these different tests. Present value of lease payments equal to 90% of the fair market value. Well, here's the present value of the minimum lease payments, $2568.08, and where'd we get that number? We got it from right here. There we go. There's the present value of those rental payments. And the fair market value at the beginning of the lease is $3,000, so we do a little division here, and we get 86%. Now 86% is not equal to 90% or greater than 90%. It's less than 90%. So the answer is no. And the last question here, is this generator of a specialized use? And the answer is no. It's just a simple generator that anybody could use. It's not specially built for when we get to construction. So we do have a yes here, so it is a financing lease. So what does a financing lease mean? A financing lease means that when we get to a construction, even though it's a lease contract, they are in essence buying this generator. Sounds kind of crazy. They're going to have to give this generator up at the end of 3 years. But according to our financial statements and accounting rules, when we get to a construction is buying the lease. Coming down here to the amortization table, this is a very important step, and if you don't get this right, everything else will be wrong, so you got to get this right. Now, one way to know if you're getting it right is this bottom right-hand square here should be 0 or very close to 0, like maybe only a couple of pennies away from 0. But if you're $100 off or $1,000 or $1,500 or $1 billion off, you did this wrong. So here's how it works, folks. Here's the amortization table. So what we do is on the left-hand side, we put the payment dates, and we're putting 1-1, 2001, and simply the beginning capitalized amount here, $2568.08. Where'd we get that number? Well, it's showing up a lot of places here, folks. Look at this. Total amount to be capitalized by when we get to it. The lessee, there we go, $2568.08. It's the amount of that the asset will be listed on the balance sheet. Now on 1-1, 2001, also the same day that the lease is signed at the beginning of the lease, when we get to construction's got to make their very first payment of $998.12. Where'd that number come from? Well, it came from right up here. We figured it out. There it is. $998.12. It's the total amount that must be paid. So coming back down here, the executory cost is $100. Now we don't have any interest on this very first payment because no time has gone by. This is the same day that the lease is signed, so no time has gone by, and interest requires time. Reduce lease liability. Well, here's what we do. We take our lease payment, minus away the executory costs. Normally we'd minus away the interest also, but there's no interest. We get $898.12, which leaves us with $1,669.97. Where does that number come from? Well, it comes from here. $2,568.08 minus $898.12 equals $1,669.97. And here's this at the beginning of the second year, January 1st of the second year. $998.12 is the payment. Executory costs are $100. The interest is $83.50. How do we get $83.50? $83.50 is found by 5% times the balance from before, $1,669.97, and you end up with $83.50 if you multiply the two together. So reducing the lease liability, all you do is take the lease payment, minus away the executory costs, minus away the interest, and bingo, that's how much you're going to reduce the lease liability. So all you do, $1,669.97 minus $814.62, and you end up with $855.35. And at the beginning of the third year, this is the beginning of the third year, not the end of the third year, payment $998.12, executory costs $100, the interest is $42.77. How do we get that? Well, it's 5% of the previous amount, and you get $42.77. Reduce the liability, $855.35. That's from $998.12 minus $100 minus $42.77. You get $855.35. And folks, $855.35 minus $855.35, you get zero. So this amortization table worked out quite nicely. Lastly, we've got to create a depreciation schedule because according to the accounting rules, when we get to a construction, the lessee is buying this generator. They're not just renting it, they're actually buying it, which again is kind of crazy because they have to give this generator up at the end of the third year. But nevertheless, since they are buying this generator, in essence, they need to depreciate it. So here's what we do. We're going to create a depreciation schedule. So amount to be capitalized, $2,568.08. Where is that number from? Well, it came from all over the place here. Here it is right here, and you could go up and find it probably 2 or 3 other places. Now, do not subtract unguaranteed residual values, so don't subtract that. Amount to be depreciated, $2,568.08. The smaller of the lease term or economic life, well, the smaller of the lease term or economic life, well, the lease term's 3 years, the economic life is 4 years, so 3 is the smaller number, so that's what we will go with. So all you do is take $2,568.08 divided by 3, and there you are. And it's pretty close to the payment here, minus the executory cost. Not exactly the same, but that's okay. It'll all work out. So the depreciation schedule at the end of year 1, it'll be depreciated for $856.03. At the end of year 2, it'll also be depreciated for $856.03, but at the end of 12/31/03, it'll be depreciated for $856.02, and I changed it by a penny so that way it would work out nice and even here. So coming down to the journal entries. So folks, I'm going to split the screen here so you can see what is going on a little bit better. So here we go. So this is at the very beginning of 2001. Record the lease on January 1st, 2001. We've got leased equipment, $2,568.08, and lease liability of $2,568.08. Where does that number come from? It comes from the very first number on our amortization table. And it's called, we're debiting leased equipment. We're not debiting right of use as we did with operating leases, because when we get to a construction is essentially buying this generator. So we have leased equipment. It'll go under property, plant, and equipment. It's a tangible asset. So coming down to the next journal entry, also on January 1st, 2001, we are going to debit lease liability for $898.12. Where does that number come from? It comes from right there. We've got that maintenance expense, that executory costs, $100 comes from right there. And the amount of cash that is being spent is $998.12. So it all comes from this very first line here. Now we're not done with the first year. We got to come down here. We got a couple entries at the end of the first year, at the very end of the first year. And at the end of the first year, we have some interest expense because there is a debt involved here, and it happens to be $83.50. We figured it out right on our table. And what's going on here is at the end of 2001, December 31st, 2001, interest has accrued of $83.50, but we're not going to pay it until the very next day on January 1st, 2002. So it's interest expense, interest payable. We've got depreciation expense here, depreciation expense of $856.03. Where'd we get that? We got it off of our handy little depreciation schedule. There it is, depreciation schedule, $856.03. So coming down here to entry number 8. Here we are, step number 8, entries for 2002. Lease liability is being debited for $814.62. That comes from right there, folks. We get it right off the table. The maintenance expense here are the executory costs and the interest payable that we recorded the day before. $83.50, and the amount of the payment is $98. So this amortization table is very, very helpful. And then at the end of 2002, we've got a couple more journal entries. They're just like the journal entries that we did at the end of the first year. $42.77 is the interest. So we have interest expense, interest payable of $42.77, and that will be paid on the very next day at the beginning of 2003. Depreciation expenses, $856.03, $856.03. Where'd we get that? Off of our depreciation schedule. Coming down to the very last year of the lease. So to record the lease payment on January 1st, the beginning of 2003, here we go. So the lease liability is being reduced by $855.35. Got it right from there. Maintenance expense, $100. Got it from there. Interest payable, $42.77. Right from there. And the amount of cash being paid is right there. Now you notice that this is the end of the amortization schedule because it's all zeroed out at this point. At the end of year 3, December 31st of year 3, this is the day we're giving back the generator back to Power to the People. So when we get to construction is giving up the generator. So here we go. What we do is this first entry, and I've got it in bright red here, no interest at the end of 2003 because the lease liability was paid off totally, completely right here at the beginning of year 3, January 1st, 2003. So no interest is accrued. There was no debt. Depreciation expense, got that right off the table. It's a penny different, but if you look at our depreciation schedule, you can see why. It's just so it comes out nice and even. Now here's the very last entry, recording the return of the asset to the lessor. Accumulated depreciation, $2568.08. Leased equipment, $2568.08. So we're reversing out the equipment and the accumulated depreciation, and they're both equal, so they just reverse each other out and they go off of our books. They're being removed from our books. So if you've been following these videos, it's a very methodical process. If you go through this process step by step as I did, it's really not too hard. At first, leases can be very, very confusing, but if you go through this step by step, very methodically like I did, it'll sort itself out quite well. So I hope you guys learned something, and if you did, hit that like button so I know that you are watching these videos and they're helpful, and I'll keep making more for you. Hit that subscribe button too, and I'll see you next time. Over and out.